So this is part number 36 of this multi-part video series for positional stock traders. In this video, I am going to discuss how do you interpret volume and price, especially the volume inside a base. I will discuss what to look for inside a base on a weekly chart. Okay. So this is MOIL weekly chart. Remember, long ago, I had made a video on MOIL. I had taken this trade. Those days, I used to discuss stocks before the SEBI regulations came. But these days, I don't discuss individual stocks. I take old stocks. So this is April 2024. As per the latest SEBI guidelines, we are only allowed to discuss old stocks or charts which are at least 3 months old, right? So this is 15th April 2024, more than a year ago. Have a look at this base. I had taken this trade. I had taken this trade on the daily time frame chart, and that video is still there on my YouTube channel. Now, before you look at a base, just ensure that before you take a trade on a weekly chart, on the daily, you have the blue, green, red, which means the price is above the 50-day simple moving average. The 50-day simple moving average is above the 150-day simple moving average, and the 150-day simple moving average is above the 200-day simple moving average. That's the basic Mark Minervini qualifying criteria. Okay, it's got nothing to do with fundamentals, comparatives, liquidity, anything. That's the basic technical criteria to look for. So this is 15th April week. So 15th April would end on, let's say, 15th, 16th, 17th, 18th, 19th, right? During that period, April 2024, let's look at the situation of moving averages on the daily time frame chart. So if we look at daily, this is the daily time frame chart. You see that breakout happening, but this is 15th of April. This candle is 15th of April. Okay, after 15th of April check. See blue, green, red. The price is above the 50-day. The 50 is above the 150 and the 150 is above the 200-day simple moving average. So the basic qualifying criteria is met. Okay. Coming back to the weekly chart. See, unless the moving average criteria on the daily time frame chart is met, do not take a trade on the weekly time frame chart because you are violating some basic rules. Okay. So those are things that are non-negotiable. Now, if you take a trade on the weekly chart without looking at moving averages on the daily time frame chart, uh, you are incurring additional risk. I am not saying don't take the trade. I am saying you are incurring additional risk. If you are willing mentally, emotionally to take that risk, then of course go ahead and buy the stock. Nobody stops you from buying any stock. Okay. But what I'm saying is that people like Mark Minervini have spent enough time in the market to realize that almost 98% of all the leading stocks of the past 100 years have been already in a stage 2 confirmed uptrend before they began their full scale advance, which means the true winners, they are always showing that blue, green, red criteria satisfied before they began their long journey upwards or long rally upwards. So why not stick with the 98% club rather than the 2% club? Why not be safe than sorry? Correct? So the more strict we are with our criteria, the lesser is the risk that we are incurring. So that is why I always continue to talk about looking at the daily time frame chart for moving averages at least, and then coming back to the weekly time frame chart, even though you are trading the weekly charts. Okay. And of course, the price has to be above the 10-week simple moving average before the breakout. Okay. Coming back to the weekly, have a look at this base. It's a nice cup with handle. This was marked on Market Smith as a cup with handle. So it's like this nice cup and then the handle. Okay, let me remove this. So how do we remove this? This is always confusing. Yes. Then this dot and then this dot and this dot also. Okay, that's a cup with handle. So the high of the handle, which is this bar, 351.50, the high of this bar, that's the pivot point. So let us draw the pivot range. So this is 351.50, 351.50. Then you draw the 5% pivot range, 351.50 multiplied by 1.05, that is 369.07. 369.07. Let's give it blue color. That's the pivot range. Okay. Then you draw the selling range, green color. This is 351.50. I have a calculator here, multiplied by 1.2, which is 421.80. 421.80. And this is 351.50 multiplied by 1.25, which is 439.37. Okay. So you see that green zone, that's the selling zone. And the stop loss range. So this is 351.50 multiplied by 0.92, 323.38, 323.38. That's the 8% stop loss. Then this is 351.50 multiplied by 0.95, 333.92, 333.92. That's it. Let's give it red color. Okay. This is very simple. Now, have a look at this base. I want you to focus on the red bars only. Okay. How many red bars inside the base? 1, 2, 3, 4, 5, 6. Out of 6 red bars, how many red bars are high volume? Okay. 1, 2, 3, 4, 5, 6. Not a single red bar out of 6 is high volume. What does that mean? That means institutions are not selling. The volume is low, which means only retail participants are selling. This is a sign of institutional accumulation. The first thing I look for when I look at a base is the number of red bars inside the base which have high volume. Okay. Here, not a single red bar has got high volume, which is a point in our favor. Okay. What is a red bar? Red bar is a down closing compared to the previous week closing. So if this is a red bar, then the closing of this week is lower than the closing of the previous week. Green bar means the closing of that week is higher than the closing of the previous week. Okay. So there is up closing and there is down closing. Down closing, red color, up closing, green color. We are only focusing on down closing because the stock is closing below the previous week close. So we are curious to know who is selling. Okay. Who is making the price close below the previous week close? Who is making the price close below the previous week close? It's the retail participants because the volume is not high. So the first thing I look for is the volume profile on the red bars. Now you understand up closing, down closing. There is also something called as strong closing, weak closing. Strong closing, weak closing does not depend on the previous week. It depends on that particular week. Where is the closing actually happened? Has it closed above the midpoint of the bar or has it closed below the midpoint of the bar? So if you see this, this is a down closing bar because of a red color, but it's a strong closing bar because the closing price is above the midpoint of that particular bar. Midpoint is high of the bar plus low of the bar divided by 2. That's the midpoint. So this is, although this is down closing, but it is also strong closing. Okay, strong means the closing has been near the high or above the midpoint of that particular bar. So remember, there are four types of closing: up closing, down closing. That is what the colors depend on. And then there is strong closing, weak closing. Okay. Why am I discussing this? Say, for example, this bar, let's say this bar came at high volume. Okay. Let's assume that bar came at high volume. Red color, high volume. That means institutions are selling, right? That would be your conclusion. But what if the closing was strong? What if the closing was near the high? Or what if the closing was above the midpoint of this bar? It means that on in that week the stock came down and then bounced back on high volume, which is actually a positive sign. Okay, so you have a look at this bar. This is a weak closing, high volume. That's a negative bar. Okay, it's down closing, it is weak closing. Okay, you look at this volume, it is down closing but strong closing. But that strong closing does not come on high volume. We want this kind of bar coming on high volume. That is actually a bullish bar. That is not a bearish bar. Okay. So in this case, if you see, all the bars are weak closing. So this closing, this closing, this closing, the remaining three, every red bar has got weak closing, not strong closing, down closing and weak closing. Okay. Thankfully, it has come on low volume, so we don't have to worry about it. Okay. That is what you would look for in the base. Another thing that you would look for in the base is before the breakout, like the handle has started to form, is it above the 10-week simple moving average? Of course, it is above the 10-week simple moving average. Then you would be interested in looking at the green bars, the upthrust, the green bars that are being shown here, they are coming on high volume. Okay, so whenever selling comes, it comes on low volume. Whenever buying comes, it comes on high volume. That is a sign of institutional accumulation. Then what else would you look for? You would look for the base count. Now, in this case, since this low was taken out by these two bars, this base was termed as base number 1, cup with handle, by Market Smith on the Market Smith chart. And by the way, during this time, the relative strength of the stock was 88. Okay, so almost all the examples that I have shown in this particular video series, every stock has a relative strength of more than 80. Okay, which is the basic thing we look for. Uh, I have not looked at fundamentals. I have not looked at industry group rank, all those things, because those historical facts are not available. I remember buying this stock personally. So I remember uh, things were looking great for this stock. Otherwise, I would not have bought the stock in the first place. Okay. So I vaguely remember. And anyways, I have the video on my YouTube channel. You can just search for MOIL and you will find, maybe there are a couple of videos. I used to make video when I would buy it, and then I used to make a video to show how I managed the trade. So you might find a couple of videos on this stock, but I wanted to show you the weekly time frame chart of this. Okay. Now have a look at now this is the basic analysis we have done. This is an early stage base. Relative strength is good. Stock is above the 10-week simple moving average. The volume profile looks good. The pattern has been marked as cup with handle, which is a standard pattern. This low was broken. That is why it became base number 1. So the base reset has happened. See, after this bar, there are 3 consecutive bars which are below the high of this bar, right? That's why that's a base. Okay. And that base was neutralized by these low. Okay. Another thing, remember, I had spoken about tight closing, smaller spreads. Look at these two bars, tight closing, smaller spread compared to other bar. Look at these two bars, tight closing. Okay. So if you have one or two tight closings inside the base, generally considered to be a good sign. Okay. Constructive basing patterns have tight price areas, and tight price areas are composed of two things. Number one, tight closings between consecutive weeks and smaller spreads in general inside the base. Smaller spread means distance between the high and the low. Okay. So these are the things you would look for. You would look at price, you would look at volume, you would look at the color of the bar, you would look at price with respect to the moving averages, You would look at tight closings. You would look at the spread. You would also look at the daily time frame chart to confirm the moving averages. Then you would look at the base count. Then you would look at the green bars. Are they coming on high volume? You would mark the pivot point, pivot range, selling range, stop loss range. You are ready, provided the stock meets at least 7 out of 12 of your fundamental criteria. Very simple. In one sentence, I have described the entire trading strategy. Okay, so learn this, rewind this video and listen to what I just said 1 minute ago again and again and again and again. Okay, take notes. It is very important that you take notes. Now comes execution. Look at the volume. What is the average volume? 11.72 million. So let's say 12 million. Okay, so 12 million volume is coming every single week on average in this stock. 12 million means every day how much it is coming? 12 divided by 5. 12 divided by 5, which is 2.4 million. So Monday, we would expect the stock to show us at least 2.4 million of volume. Let's see on Monday what happens. Okay, I will move it one day forward. So see, Monday has come. Okay, the stock has gone up from the previous day close. How much volume has come? 3.65. Look here. Look here. Okay, this area. This is Monday. This is not a weekly bar. It only has Monday. Okay. How much were we expecting? 2.4 million. 12 million average volume divided by 5 days in the week, that is 2.4 million. We were expecting 2.4 million, but look at that volume, 3.65 million. What does that tell you? That tells you that we are getting higher than expected volume. That means the breakout is likely here. Get ready to buy the stock. Now let's assume whatever be your position size, you decide to buy 100 shares. Okay. Let's go to Tuesday. Look what happened. How much are we expecting on Tuesday? Monday 2.4 million, Tuesday 2.4 million. So 2.4 plus 2.4. We are expecting 4.8 million by the end of Tuesday. But how much are we getting by the end of Tuesday? It has already crossed 19 million. So expectation is 4.8 million. Actual is 19 million. Okay, we are expecting around 5 million. Actual, we are getting almost 20 million, which is 4 times, which is like 300% more than what we were expecting. Okay, when you look at the volume bar on the weekly time frame chart, this might look like it's only 30% or 20% above the average weekly volume, right? That is what it looks like. But actually, if you see, this bar only contains Monday and Tuesday. Okay, so we are actually getting 300% more volume than what we expect. So I'm extrapolating on a per day basis how much we should expect. So 2.4 million on Monday, 2.4 million on Tuesday. That's 4.8 million. And what are we getting in 2 days? 19 million, almost 20 million. So you expect 5 million, but you get 20 million in 2 days. That's like 300%, 400% more than expected. So what do you do in such case when you get such explosive breakout? You buy all your 100 shares. So on Tuesday, when the stock actually enters the blue zone, you buy 50 shares, wait for the stock to go 1 or 2% again, buy another 30 shares, again wait for the stock to go 1 or 2% more up again, buy another 20 shares. So this is William O'Neill teaching stuff to Patrick Walker. Patrick Walker says buy in installments 50, 30, 20. So that once you buy the 50, there is a possibility that the volume might go up, but the price might come down. So if that happens, don't buy the remaining 50. Similarly, after 50 shares, you buy 30 more shares if the volume and price is going up. After you buy those 30 shares, if the volume is going up, price is going down, don't buy the remaining 20 shares. Okay. So you gradually acquire the shares that you planned to acquire within this yellow buying range. So you had the entire Tuesday. I mean, Tuesday, you had enough time to accumulate the stock. The stock must have spent like 2-3 hours inside the blue zone. I don't know. Maybe we can check on the daily time frame chart, but you can check it later. But what I'm saying is, if the stock went from Monday to Tuesday beyond that blue zone, that means on Tuesday, the stock spent good enough time inside that 5% range. Even if it spends like couple of hours, 3 hours out of total 6 hours, you have enough time to buy the stock. You would have set your alerts and things like that. And when you see tremendous amount of volume coming in, 4.8 million would have been crossed on Tuesday by 10 o'clock or 11 o'clock in the morning, right? So that gives you even more incentive to pick up all the shares that you planned to buy without waiting for that 50, 30, 20, right? Let's go to Wednesday. Wednesday, it continues to go up. Thursday, it already reached that 20-25% range. So Thursday, you could start thinking about selling the stock, right? Not selling all shares, but selling partial. Maybe you would like to uh, sell one third of your number of shares, one fourth of your number of shares, or one half of the total number of shares you have, depending on how conservative or aggressive you want to be in this position. But you are getting an opportunity in the same week, that too on a Thursday, not a Friday. The week is not closed yet. So imagine buying a stock on a Tuesday and being able to book profit on Thursday or Friday in the same week. That's a delight. That is like music to any professional positional trader's ears. I remember selling this stock at that range in the same week. It was an absolute delight for me. Okay. And Friday, finally, the week closes in one single week. Okay. The stock shot up 27.31%. Look here. One single week, the stock shot up 27.31%. How does it look on the daily? It looks something like this. I think this was Tuesday. Okay. So, oh, sorry. Yeah, this was Tuesday probably. During this period, it went up 9.60%. So, your blue zone, the blue shaded area on the weekly, would have been somewhere here, right? So, there was time during the day to accumulate the stock. And look at the volume that came on that day. 15 million came on a single day. We are expecting 2.4 million coming on that day. Instead of 2.4 million, we are getting 15.39 million. Okay, so 2 million, 2.4 million would have been covered in less than 1 hour. So that itself was a clue that you pick up all your shares in one go rather than doing it 50, 30, 20. So you have to catch that rapid price movement. Okay, so we have discussed trade execution. We have also discussed trade management. We have also discussed partial selling in this. Let's say you decide to sell one third in this, okay, and the stock closes inside that, below that green range. Okay, you sold one third, you still have two third. On that two third, where do you think your stop loss will be? Your stop loss will be at the break even wherever you bought the stock, right? So that you neutralize the position. Now you are in a risk free trade. Initially, when you buy the stock, your stop loss would be 8% below your average execution price. Your average execution price will be bit inside that blue zone. Okay. Now that the stock has closed below the green zone, now there is incentive for you to sell more of your shares, right? When it again enters the green zone, because now you are sitting on a risk. It went up, came down, or it could completely collapse from here. So now we are looking for the next opportunity to sell. Let's see what happens next week. See, it goes inside that green zone again on Monday next week on high volume. This is 5.47 volume. So you get an opportunity to sell another one third. Why would you sell that one third? Because in this week, the closing was below that selling range. So probably the stock could have collapsed from there. It happens. It goes up suddenly and completely collapses, right? So we want to take some money off the table, right? So conservative traders would want to book another one third there and keep the last one third. Aggressive traders would want to keep the stock as long as it remains above that 10-week simple moving average. That's the simplest way to manage a weekly positional trade. As long as the fundamentals remain good, as long as the stock continues to go up, okay, everything is fine. I'll move it forward, right? Let's see what happens. I think this stock went up like 60%. before it began to fall. See, it continues to take support at the 50-day simple moving average. Finally, it closes here, that too on low volume. But let's see how far it went from the pivot point. So from pivot point, this was like 65%, right? This is how it looks like. So from here, went up to 65 odd percent. Okay. And then it finally came and closed below. See, all of these bars are above the 10-week simple moving average. This bar closes below the 10-week simple moving average, but on low volume. That is not a sell signal. Normally, if it is high volume, that's a sell signal. Look at this bar. This is what I was explaining. This is a down closing, but a strong closing. Why down closing? Because it is red color. Why strong closing? Because the closing is above the midpoint of the bar, but it doesn't mean much because the volume itself is low. Okay, you understand now? So that's the trade I wanted to discuss with you. So everything that I am discussing, it's already there on the chart. In fact, I would say the weekly chart trading is much more easier than daily time frame chart trading. A lot of my students after this series have told me that weekly chart trading is much more simpler than daily because here we don't use candlesticks. However, this kind of trading requires a lot of patience. You have to sit with the stock for weeks, months. Very recently, I have bought stocks where I have been sitting on them for like 2 months, still holding on to partial position in the stock. So it requires a lot of patience. Okay. And traders generally don't have patience. So if you don't have patience, stick to swing trading and positional trading on the daily time frame chart. Also do little bit of weekly time frame positional trading. But if you are strictly a positional trader on a weekly chart, you have that temperament to wait and ride the stock, even if you buy in this range, okay, and sell as long as sell the moment the stock closes below the 10-week simple moving average on the weekly. See, from here to here, you still end up booking 40% gain, but it takes a lot of time to go there, by the way. So how many months? 1 2 3 4 5 6 7 8 9 10 11 12 13. So 12 weeks, that means 3 months. So you have to wait for 3 months to book that 40% return. But 40% is a very good return in 3 months, by the way. It's worth waiting till that time rather than doing intraday and stuff and scalping and here and there. Just sitting on a stock for 3 months, booking a nice 40% gain. Fantastic way to trade, isn't it? So just to summarize, what would you look for? You would look at price. Sorry. Just to summarize, what would you look for? You would look at price, you would look at volume, you would look at price versus the moving averages, you would look at tight closings, you would look at small spreads, you would look at red bars along with their volume, you would look at green bars along with their volume, you would look at the daily time frame chart to confirm whether the blue, green, red moving averages are in place. You would look for the type of pattern. This is a cup with handle. You would also look for the base count, and you would do liquidity analysis, comparative analysis, technical analysis, fundamental analysis, market analysis before you decide your position size. Then you would execute the trade by extrapolating volume, calculating how much would you expect on a Monday, Tuesday, Wednesday, Thursday, accordingly accumulating shares in tranches of 50%, 30%, 20%, and then managing the stock, doing some partial selling in the green zone, holding on to the remaining stocks as holding on to the remaining shares as long as the stock remains above the 10-week simple moving average. Okay, one sentence I have described the entire trading strategy for you. Everything that I've just said, all is available on the weekly time frame chart. Just make notes of what I'm looking, what I'm talking about: price, volume, moving averages, green bar, red bar, volume versus the color, right? All of these things, if you just note down, if you just prepare a checklist and start looking at these things, I mean, don't you think that will improve your skill as a weekly chart professional positional stock trader? Of course, it will increase your improve your skill. And we are not just buying any random stocks. We are buying stocks with high relative strength. We are buying stocks with good industry group rank. We are buying stocks which meet at least 7 out of 12 of our fundamental criteria. We are buying stocks in the early stage. We are also probably buying stocks where the relative strength line is showing up slope, where you have a blue dot inside the base on the relative strength line, which indicates that the relative strength line is at or near the 52-week high. I am not talking about RSI. I am talking about the relative strength line, where the stock is compared to the performance of the Nifty, right? All of these things you look at, you take a position in the trade, execute the trade, manage the risk with a stop loss, move your stop loss to break even on partial selling, manage the trade, ride the profits as long as the stock remains above the 10-week simple moving average. That's called professional trading. Okay. I hope this video has been helpful to you. Thank you so much.